Hello, and thank you for tuning in to the MAC-Desk Floor Report for Friday, September 2nd. I'm Rebecca Darst from the MAC-Desk, speaking to you from the floor of the exchange, where we are under a bit of pressure this morning, to put it euphemistically, on a disappointing jobs number. We were set up to sell off a little bit today after a 4-day win streak was broken as the S&P failed for a second straight session to break through resistance at the 1230 level. This was an art, cash, and technical level, and equities backed up from there as traders lightened up in anticipation of the long weekend and what was roundly expected to be a disappointing jobs number. So how bad was that jobs number actually? Well, the fact that the Dow has been down better than 200 points for much of the morning so far suggests that the number wasn't entirely baked in, even with dour whisper numbers making the rounds late yesterday. Nonfarm Payroll showed a gain of 0 for the month of August, the weakest reading in about a year, and marking the first 0 reading since February 1945. So what's the off-the-cuff analyst reading? Well, some have noted that while the number was certainly disappointing, it may have been distorted to the downside a little bit by seasonal factors, and the private payrolls component would have been 62,000 without the effects of the Verizon strike. On the other hand, other analysts say that while seasonality may have been a factor, there are no real catalysts for hiring left on the calendar. Alternatively, with market observers looking for some kind of QE3, which we didn't get last week, an ugly data point like today's jobs number provides the perfect entree for the Fed to take some kind of action. So risk assets are taking a hit this morning, and while the yield on the 10-year is down about 4% at 2.04%, that August 18 low of 1.97% has remained intact and relatively unchallenged. Interesting action to report out of Europe this morning as well. European shares were already under pressure overnight before the U.S. jobs number hit the tape. What we saw, however, was a divergence in demand for European government debt. The yield on the 10-year German Bund hit a record low, breaking below 2% for the first time ever. Yields on British gilts also plummeted as investors sought safer assets. Yields in Italian and Spanish government debt, however, rose, so the north-south bifurcation was very pronounced this morning. Gold is up around 3% at $18.77 per ounce, and the spot reading on the VIX, which just recently began trading at a discount to near-term futures as volatility eased off, shot higher off the open, but that 35 level, which is sort of a crisis level, remained intact, and we're trading about 6.5% higher at 33.87 right now. Financials are leading the S&P lower, with the sector down around 2.5% broadly. But so far in options trading, much of the action that we're seeing so far is in weekly expiring September 2nd S&P spiders at close to the money strikes. So the market is showing evidence of very nimble short-term positioning. For additional market insights, check your inbox at 1 p.m. for the MAC-Desk Midday Report. For now, that's all from me, Rebecca Darst, for the Floor Report.